Fed officials offer stronger signals for a September cut, but by how much? Welcome to Market Insights. I'm Peter Devlin. At Jackson Hole, Powell confirmed the time has come for policy to adjust. Traders added to bets that the Fed will cut interest rates starting next month, but the magnitude and pace remains an open question. Can we expect a gradual or more aggressive approach? Joining me now to talk about all that is James Knightley, Chief International Economist at ING. Welcome, James. So starting off with the Fed's preferred inflation gauge due on Friday, PC prices are expected to firm further after last month's rise. So could a higher reading derail expectations for a cut in September?
Well, I think, if we're looking at the inflation print this Friday, we've got a pretty good handle on what it's going to be. We know a lot of the inputs from the consumer price inflation report, a lot of inputs from the producer price inflation report. So it's got to the point where analysts here are now forecasting to two decimal places. So that gives us a decent expectation that it's going to be either 0.2% or below. And there's not a single person expecting anything above that. And that should just really allow us to then focus on the jobs story. And that's, I think, is going to be critical to determine what the Fed does on September the 18th.
So you mentioned that the jobs report is critical. Powell said that we've made good progress on inflation. So overall, has the Fed stopped worrying about inflation?
It's not stopped worrying about inflation, but in terms of the balance of where it weights the importance in terms of the outlook for policy, it has been diminished. And given the recent jobs numbers that we've been getting, which have been pointing to cooling, rising unemployment, falling hours worked, that softening there and also in hiring demand indicators does suggest that they perhaps need to be a little bit more mindful of what's going on in the jobs report. And that is why, as you mentioned, the Jackson Hole commentary from Jerome Powell, the Fed minutes from July 31st decision do suggest that it's that emphasis being put more onto the job story now that's really going to determine how far and how fast the Fed go.
So with all that in mind, how impactful will the next month's NFP print be?
Very. At the moment, we've got a situation where the market sees the chance of a 50 basis point cut, but it's favouring a 25 basis point cut. Now, with inflation, we've got a pretty good handle on what that's going to be. That shouldn't really swing the debate at all. It's all about those job stories. And if we see perhaps a payrolls number that comes in on the softer side, say sub 100,000, and the unemployment rate rising further to say 4.4, possibly 4.5, then I think a 50 basis point move would be the more likely outcome, given the Fed's emphasis on not wanting to see any further weakness in the labour market. But if it's a jobs number, say 150 or above, unemployment stays at 4.3%, perhaps drifts a little bit lower, perhaps there's no need to step on the gas and they can just keep maintaining, well, they can go with that 25 basis point cut. That is still essentially the market's favoured choice right now.
So comments as well from former Fed Vice Chair Roger Ferguson. He said that they expect a series of 25 basis point cuts. What do you expect for the rest of the year?
Well, that is normally what the Fed prefers to do. But as I said, if the data is there to justify it, I think the Fed will step on the accelerator. Because remember, if we look back to those minutes from July, they said that there was actually some could see the plausible case for a 25 basis point cut in July. And we had the minutes to the discount weighting decision published yesterday. And we actually had Chicago and New York voting for a cut in the discount rate there. So that clearly sets the tone that perhaps some do feel that there is scope for a little bit of catch up. And if we do get a soft jobs number as well, coupled with that idea that perhaps some were thinking they could have gone in July, then that may still make a 50 basis point cut a distinct possibility.
So just under 70 days now until the US election in November. Do you think this will have an impact on Fed decision making?
Not this year, but certainly next year, because, of course, if we look at the big policy differences between Kamala Harris and Donald Trump, Kamala Harris is proposing a slight tightening of fiscal position. She's looking to raise taxes coming through from 2026. Whereas, of course, Donald Trump wants to lower taxes. He also wants to put in tariffs. He also wants to control immigration. And I think that combination under Donald Trump of perhaps more support for the consumer through tax cuts, more inflationary pressures through higher tariffs, and potentially more wage pressures if he's successful at constraining immigration. That sort of slightly stronger growth, slightly higher inflation print may mean that 2026 policy from the Federal Reserve perhaps will be tighter than it may be under Kamala Harris. But I think for next year, certainly for this year and early part of next year, I don't think it's really going to come into the Fed's thinking.
James Knightley at ING, thank you very much for your thoughts. And that's Market Insights. Don't forget, you can watch more videos on Reuters.com.